let me paint you a picture. It's the beginning of last year, and you're sitting on some cash. Maybe it's your emergency fund, maybe it's money you saved over the past couple of years, maybe it's the bonus you told yourself you'd figure out later. And here's the thing, you feel good about it. You feel responsible. Smart even. Because after everything that went sideways in markets the last few years, having cash felt like the only thing that made sense. And now it's 2026, inflation is running hot again, and somewhere in the back of your mind, something doesn't feel right. You check your bank balance, the number looks the same. But nothing you buy costs the same. And that's the moment I want to talk to you about today. Because what's happening to your cash right now isn't dramatic or loud, it's quiet. And that's exactly what makes it so easy to ignore, until it isn't. Here's what most people get wrong about cash. We treat it like it's neutral. Like keeping money in savings or in a checking account is simply doing nothing. A pause, a holding pattern, a safe harbor while we wait for things to make more sense. But cash isn't neutral. It never has been. Every single day your money sits still, the world around it keeps moving. And in an inflationary environment, especially the kind we're sitting in right now, that stillness has a real price tag. It's just one that never shows up on your bank statement. And I want to be careful here, because I'm not trying to make you feel like you've done something wrong. The impulse to hold cash is deeply human. It comes from a very real place of wanting control. After years of economic whiplash, pandemic spending, rate hikes, layoffs, a housing market that made no sense, sitting in cash felt like the rational move. And honestly, in some seasons it was. But we're in a different season now, and I think it's worth slowing down and actually looking at what that choice is costing you. So let's talk about what inflation actually does to cash, in terms that feel real rather than textbook. If inflation is running at around 4 to 5%, which is roughly where we are in 2026 based on current trends, and your savings account is paying you, say, 2% interest, then you're not breaking even. You're losing somewhere between 2 and 3% of your purchasing power every single year. On $20,000, that's $400 to $600 quietly disappearing, not from your account. From what that account can do for you. Think about it this way. The $10,000 you set aside 2 years ago could buy a certain amount of groceries, cover a certain number of months of rent, or pay for a car repair without flinching. That same $10,000 today buys less of all of those things. The number didn't change. The world changed around it. There's actually a name for this in behavioral economics. It's called money illusion. Our brains are wired to anchor on the nominal value of money, the digits on the screen rather than what it actually buys. So we see $10,000 and we feel like we have $10,000. And technically we do, but functionally, over time, we have less. And the gap between what we think we have and what we actually have in terms of real value, that's the hidden cost. Now here's where psychology gets interesting. Research consistently shows that people feel the pain of losses far more acutely than the pleasure of equivalent gains. Which means the slow, quiet erosion of cash through inflation doesn't feel like a loss. There's no red notification, no scary chart. Your balance looks fine. So your brain doesn't register it as a problem. And that comfort is part of what keeps people stuck. The other piece of this is what I call the waiting for clarity trap. A lot of people sitting in cash right now aren't doing it because they love cash. They're doing it because they're waiting. Waiting for markets to settle. Waiting for a better entry point. Waiting to feel more confident. And that feeling makes sense, truly, it does. But here's the uncomfortable truth. Clarity rarely arrives on schedule. And every month spent waiting is another month of real purchasing power quietly leaving. Here's the mindset shift that I think changes everything. Stop thinking about the question as, is it safe to invest right now? And start asking a different question. What is the actual risk of staying where I am? We tend to think of risk as something that only lives in markets, in stocks going down, in volatility, in uncertainty. But staying in cash during inflation is also a risk. It's just a slower, softer, more invisible one. And because it doesn't feel like risk, we don't weigh it against the other options properly. When you start to see cash not as a safe harbor but as a choice with its own cost, everything shifts. You're no longer asking whether moving is scary. You're asking whether staying is worth the price. And that's a much more honest conversation to have with yourself. So what does this actually look like in practice? And I want to be real with you here. This isn't about rushing into anything, and it's certainly not about putting your rent money into the stock market. That's not the move. The first thing worth doing is separating your cash into what it's actually for. Your true emergency fund, 3 to 6 months of expenses, should stay liquid and accessible. That cash has a job. Don't touch it. But beyond that buffer, if you have money sitting in a basic checking or savings account earning near nothing, that's worth looking at more carefully. For cash that isn't needed in the next year or two, high-yield savings accounts and short-term treasury instruments have been offering meaningfully better returns, in some cases, rates that actually keep pace with or partially offset inflation. That's not glamorous, but it matters. It's the difference between losing 3% and losing 1% per year in real terms. And for money you genuinely don't need for 3 or more years, a diversified low-cost investment approach, index funds, for example, has historically been one of the most reliable ways to stay ahead of inflation over time. Not guaranteed, not without short-term bumps. But over years, the math tends to work in your favor in a way that cash simply cannot. The point isn't to be aggressive, it's to be intentional, to make sure your money has a job, not just a parking spot. If you've been sitting in cash and this video made you feel a little anxious, I hear you. I'm not here to pile on. Honestly, just the fact that you're paying attention, that you're asking questions, that you're trying to understand what's happening around you, that already puts you ahead of most people. The goal isn't to be perfect, it's to be slightly more aware than you were yesterday. To stop letting the invisible costs stay invisible. To give your future self a little more to work with than your present self had. Money is emotional. It's tied to safety, to identity, to everything we're afraid of losing. And understanding that, really sitting with it, is the first step toward making decisions that actually serve you. Progress beats perfection. Every time. So don't miss out. Subscribe now, stay ahead of the curve, and I'll see you in the next one.